Good evening and welcome to the webinar. My name is Peter Reznicek from shadowtrader.net. I am the head trader for shadowtrader.net and the founder. We've been doing this for quite a while. Shadowtrader.net started back in 2006. I also run something called the Weekly Options Advisory, which is a live trading advisory and room as well. And that room is identical to the room that you're in right now. So just so you know, this is the pro trading room that you're in. And if you do decide to become a subscriber, you have full access to this room where I broadcast every day, but you also can download the Shadow Trader mobile app from the Apple App Store or Google Play, and you can follow along on your mobile as well. So let's get into it. How I trade weekly options. Let's start with just something basic here, just to kind of get our feet wet. What exactly are weekly options, for those of you who don't know? Weekly options expire every Friday in addition to the usual third Friday of each month. There used to be options that would expire only once a month on the third Friday. Now there are plenty of options on many stocks that expire every week. And if you think about it, with the fast theta burn of those weekly options, it's pretty exciting. There's a lot of really exciting opportunities in short-term options if you know what you're doing. All right. Not all stocks have weekly options, but hundreds of them do. At last count, as you can see here, 521 stocks have it and about 95 ETFs, and that's from the complete list at cboe.com, as you can see there. One thing to consider if you want to start trading weekly options is, remember, when you look at all of these hundreds of stocks that have them, they are not all created equal. So I just specifically put here into this slide, I said, you know, open interest and volume are a factor and they are important. Open interest and volume are a factor and they are important. So just keep that in mind. All right, why do weekly options present such asymmetric opportunities? Like, what's special about these options as opposed to regular options? Well, as I was saying, much shorter time to expiry, all right, which is important, gives you much better odds of figuring out direction and target. And this is super duper important. Much faster theta burn, I touched upon that, right? When you look at a graph of how things accelerate to the downside, right, in terms of the theta, right, it kind of goes like this and it goes down like this, right? And so that's important. And this marked line here where it really starts to accelerate is about 2 weeks out, right? That's very, very important. It's just about 2 weeks is right about the time where it starts to really accelerate. And so because we play in that sort of arena, it can be very, very exciting, and there's a lot of different things that can be done with it. All right. There's also a potentially explosive appreciation of very short-dated long options if they go into the money. Obviously, that is due to something called gamma, right, where the delta accelerates very quickly, and the delta gets closer and closer to 100 or 1, however you want to look at it, and then it trades more like stocks. There's definitely some exciting opportunities there as well. All right. What do I do with weekly options? So I've been running this weekly options advisory for over 6 years now, and it has been consistently profitable. And I will tell you right now up front, I am one of the only people on the internet that actually keeps track of all their trades from start to finish in a spreadsheet. And I offer that spreadsheet to every subscriber every single night. Everybody has access to it. And I'll show you what the equity curve looks like in a moment. Towards the end of the presentation, you'll see that it has been very steadily profitable for the entire 6 years, and we're generally almost always at our high watermark for profit, which I think is pretty impressive because, like I said, not a lot of people do it this way. A lot of advisories will just give you trades, but they don't really keep track of the trades, and you don't really know if they actually make money or not. But this is not like that. This is very transparent, and I keep track of everything, and subscribers get to see everything up close. All right. So what do I do specifically? This is my strategy in a nutshell, and I'm going to show you some examples of how I effectuate that strategy. But if I had to encapsulate it all into one thing, I would say I look for events on charts where I believe price will either go or not go, right? Pretty simple, right? You find something on the chart, you say it's either going here or it's not going here. And once I know that, I figure out, am I going to collect credit? Am I going to be, meaning I don't think price is going there, right? I'm obviously shorting options where I don't think price is going. I think we've all done that if you've ever traded options. Or am I going to be directional, meaning I want to speculate on price going from A to B? Or am I going to do both at the same time? And you might think to yourself, how is that possible? But I'm going to show you how that's possible in this webinar. I'm going to show you 3 specific strategies that are going to either collect credit, go directional, or do both at the same time, all right? So once I have that, I then have to choose the proper spread that will achieve my objective at the least possible cost, outlay, and risk. This is very important. Within this bullet point, this 3rd bullet point, this is really what I think is why I've been successful consistently over time, is because I structure everything a certain way for, like I said, the least possible cost, outlay, and risk. And that's very, very important. And you'll see when I get into the live examples what I mean by that and how I do it, all right? Lastly, I try my best to be net short as much as possible. And you'll see I wrote there, death before debit. What I mean by that simply is I try my best to figure out how I can put the spread on for free. So obviously you can only put a spread on for free if you're net short. Those of you who have even just the most basic understanding of options, you know that if you want to get the cost down to free or maybe even a credit, you have to be selling something, right? Nobody's going to give you anything for free. You can't just buy a call spread for 0, but you can buy other spreads for 0 that will have the same objective as that call spread, right? And that puts you in a much better position to make money on the trade and, more importantly, not lose money on the trade if you are wrong on direction. Okay? Leveraging the power of time by being net short. This is what I'm talking about. Harnessing the power of short time to expiry by being net short. Remember, net short does not mean naked short. What does net short mean? Net short means simply that we use spreads where we are selling wider structures than we are buying, such as broken wing butterflies, or we are using spreads where we are selling more structures than we are buying, like an unbalanced butterfly, right? Like an unbalanced butterfly is essentially what? 1 long vertical and 2 short verticals. If you put it together, you get a 1-3-2 structure, and all you're doing is just selling more verticals than you're buying. Pretty simple, okay? I'm a very, very big believer in this concept of net short because I firmly believe that over time in the weekly options game, pretty much in any options game, this will be the deciding factor between success and failure over time. It really will. You will see in a second that I'll illustrate this really well. Okay, so specifically, what are some of the spreads that I employ, and more importantly, why, right? What exactly do I do and why? Okay, so the first one that I use is the broken wing butterfly. And this one I really believe should be the foundation or bedrock of any successful weekly options or short-term options trading strategy. And what is the broken wing butterfly? So very simply, I've put an example here of the broken wing, what it looks like versus the regular butterfly. So let's figure that this one is the regular butterfly. And if you're not familiar, I will show you what that is. Very simply, you're buying one option, and in the middle you sell 2, and then you buy 1. And notice that in this spread, the distance between the strikes is equal. What are the characteristics of a regular butterfly? It always costs you money to put on. The maximum value is at the short, so if the stock price ends right here, that's the most value, correct? Because this vertical will be full value and this vertical will be worth 0. So that's that. And how risky is it? Well, your risk is limited to the price you paid, which is cool. But then we have the broken wing butterfly, which is a little bit different, where this can be put on for a debit, but it can also be put on for a credit or 0. A reason for that is simply because, as I talked about earlier about how to be net short, in this case, you are selling a wider structure than the structure that you're buying. So this is our short vertical, which is very wide, and this is our long vertical. And if you can imagine, because this has a certain cost of X and this has a certain credit of Y, which is larger, this can equal 0 or a credit, which is pretty exciting because you could actually put this on for a credit or 0. However, it has the same objective as the regular butterfly in that the max value is still here at the shorts. Now, because you've put on something at credit, obviously there is some risk, right? Because there is a risk that is greater than the price you paid. Here, your risk is limited to the price you've paid. You have a greater price, however, it is defined, correct? We know that if we have this vertical and we have this vertical, the risk can't go past here. We know that this is, let's say this is plus 10 and this one is minus 15 in terms of width, equals minus 5. So our max risk is 5, even if price was to blow all the way through all strikes. Now, obviously, me personally, I wouldn't let that happen. I would adjust before that happened, but regardless. So when we look at the broken wing versus the straight butterfly, what makes the broken wing structure so much better? It leverages the power of time because it has the wider vertical sold against the narrower one bought. This is super important. I just want to focus on just this one aspect of it right now. Leveraging the power of time with a wider vertical sold against the narrower one bought. I'm a huge believer that if you do not leverage the power of time, you might as well not even be trading options. You're wasting your time, to be honest with you. If you're not interested in leveraging the power of time in options, then just buy 500 shares of stock, right? Think about it. Just buy stock, and that's fine, and speculate on direction. And if you think it's going up, short some shares of stock, and if you think it's going down, if you think it's going up, buy some shares of stock, and if you think it's going down, then short some shares of stock. And that's fine as a strategy, but it's relatively difficult because you have to be dead right all the time. Whereas obviously in options, and especially with shorter term options, you have an immense amount of leverage from the power of time, okay? Now, if you structure correctly, which is interesting, you can actually win in 3 ways. It could be either up, down, or sideways. If you go back to the example that I gave of the broken wing butterfly, right? Remember that if this structure was put on for a credit, well, then think about it. It wins if the market goes up and you come into here where you want to be. If you put it on for a credit, it wins if the market goes down because you keep the credit, and it wins if the market goes sideways because you keep the credit. So that's very important, okay? Sometimes, and I'll show you this in my examples, you can place it for a credit and close it for another credit. I'll show you that in the examples. BWBs have far lower cost, often 0 or credit, which means being wrong on direction does not lose money. This is very important. When I go into the examples of live trades that I've been doing, this is one of the things that I want to point out is that I'm not always right on direction. Nobody can be always right on direction. However, I don't really have lots of losing trades, and the losing trades that I do have, actually I shouldn't say that, I probably have the same amount of losing trades as any other professional trader. However, my losing trades are so much smaller than my winning trades because of the way they're structured. The losing trades are relatively very tiny as opposed to the winners, and the reason is because of the structure. Very simply is that, when you put spreads on in this fashion, if I'm wrong on direction, okay, who cares? I didn't pay anything. Sometimes I even collected a credit. I get a little money, or maybe I pay a very small debit, right? Instead of paying $1.50 for a structure, I paid 18 cents or something like that, all right? So it's very forgiving as opposed to a short vertical if used as a credit collection vehicle. This is important. And when we get to the live examples, you'll see this in a NFLX example that I'm about to show you, which is actually very recent, so you'll understand exactly what it is. It's a very forgiving spread as opposed to a short vertical if used as a credit collection vehicle. So I hope everybody understands the weight of that statement. And let me explain exactly what let me explain exactly what I'm trying to do here. Okay. What I mean by this is very simply that, let me just clear this. What I mean by that very simply is, if you're in a situation where you want to collect credit, let's say it's on the upside, and you do this, right? That's your spread. How are you going to feel when price does this? It's coming to my short. Oh, it's inside my spread. I might be at max loss, etc. You will have a certain feel. You see, a lot of what people miss about successful trading over time is they don't understand that what you need to do is manage your emotions. And you need to manage the way you trade so that it fits your personality, so that you can sleep well at night, so that you can perform the next day. Because being short for credit a lot of times can be very harrowing, right? It can be very scary if it's structured the wrong way, right? So that's what it looks like when you're in a vertical spread, right? Where you have like the -1, +1 like this. But what about if you were in my spread, which is the +1, -2, and then the +1 way up here? Don't you think that psychologically it's going to feel different when the market is doing this, when the market is crawling up to a strike that's actually long? This is a long strike, and this actually makes money between here and here, right? So as a credit collection vehicle, this is not going to pay you as much credit as the vertical. Obviously not, right? Unless the vertical, right? Unless it's like super wide. Why? Because obviously you paid for this bottom part, you paid for a long, and then you sold another one up here, right? So it's going to be less credit, but it's going to be more forgiving. It's a much more forgiving spread in that you will collect your money slowly over time, but if there's adverse price action going towards your spread, you're going to freak out a lot less. And that's what's really important, because again, as I was saying, what newer traders don't understand is this is as much a game of managing emotional capital as it is managing financial capital. And the person who can manage emotional capital the best, that person is usually the winner. Okay? All right, let's get into a live example. So what you see here, this is real life. This is real. This is not theory. These are actual trades. This is a snapshot of the spreadsheet that I share with subscribers every single day. As I told you earlier, I'm one of the only people on the web, I believe. I know there's others, but not many. I'm saying the majority of advisories don't do this, where I keep track of every single trade as it's done. And you'll notice I have every single in, every single out, everything is there. Every single transaction is there. All these transactions are real money fills from a real money account in Thinkorswim. I cut and paste my fill and I post it into the alerts section of the pro trading room. And again, as I was saying, that will appear here in alerts, as you can see, if you're on the desktop version. If you're on a mobile, we have our dedicated mobile app. As I was saying, you can get it in the App Store or Google Play. You'll see it right there in your mobile as well. You can also have push notifications set up. It's pretty cool. You can have, however you want to look at it, whatever. So let's use this Netflix here as an example. This was very recent, as you can see. The trade is actually still open because you can see here it actually expires tomorrow. So the trade is actually still open. But what do we do here? It's a credit collection BWB. So I'm using this as an example of how to collect credit using a broken wing butterfly. So look at the trade here that was done. It was done in 4 different pieces. And all this is basically just repeating the trade with more and more size. I'm just going bigger and bigger. Now you'll notice that in the advisory, the size is kept very, very much to a minimum. You see these sizes? My way that I put out the alerts, regardless of what I do in my own account, and you'll see in the next slide that it's different, is I always keep it here. See, it says size is kept small purposely for educational purposes and to accommodate smaller traders. So the trades are called in units. So understand that this is 8 lots altogether, right? 4 times these 2, but traders can do however many they want. And I generally will do far, far larger size. But again, this is what I post officially into the room. I'll tell people, this is the trade so that they understand what's going on. Okay, so we put on these BWBs, and what did we do here? If you look specifically here, we bought 485 calls, Then we sold 2 times 490 calls. So you see how these two strikes are very close to each other. And then we bought a 530 call, right? And that's what creates the BWB structure, right? It's +1, -2, +1. And the third strike is far away. So, right, I always like to remind people, what is a broken wing butterfly? It's nothing more than a combination of 2 verticals, of a narrow long vertical and a wide short vertical. So in this case, right, it's a long 485, 490, and it's a short 490, 530. All right, now let's look at a chart together and understand why I would do that. What's the purpose of this trade, and why am I specifically putting on these strikes? And this is very, very important when you see in the next slide why I'm doing these strikes specifically. Okay, here's a chart of NFLX daily. This is the trade setup. Okay, so you can see here, when did I put on the trade? June 14th, 2023, right here on this candle. Right here on this up candle is when I put it on. And why did I choose the strikes that I chose? Remember, it is a 485, 490, 530, and the average credit received was 60 cents. Why did I choose those strikes? It's all technical. Here's the channel. Here's the top part of the channel, and look where 490 is. 490 is the top of the channel. Now, in this picture, you can see that NFLX has come off a little bit here, but the trade was put on right here while NFLX was rallying. And this is important. Many people are generally afraid to do this, I think, or they don't do it the right way. But it seems simple, stupid, and obvious, but what I'm trying to say is many people don't pay attention to this. And that's the simple fact that if you're going to be selling calls, shouldn't the market be going up? And if you're going to be selling puts, shouldn't the market be going down? It should. It's sometimes people think that's scary, but that's the way to do it. So in this case, because my structure is a BWB, remember the concept I talked about being net short? I'm net short calls in NFLX, right? Because I have a narrow long vertical and a very wide short vertical. So I'm quote unquote net short. So when do I want to get net short? Not when NFLX is down, but in here when NFLX is going up 4 days in a row. And we managed to hit it perfectly right on the 4th day before it fell apart. And again, why did we choose the strikes we chose? Because the channel resistance is right at 490. Okay? And if you look here in the bottom left, I just took a snapshot of my actual position from my account. And this is just like to show you like what I was saying is that the sizing is different. I have 100 contracts. You used to notice, see how here it's 100 by 200 by 100. And the net credit here is here. So the trade picked up about almost $6,000 in credit in less than a week. And like I said, it expires tomorrow. And these are you can see here, these are the prices that it was put on. And if you add this up, that's how you get your net of 60 cents, your 60-cent credit, okay? And again, this is just a different way of thinking for people. And to me, it makes perfect sense. It's a new way of thinking, meaning how to sell credit. I could easily have sold a 490, 510 or whatever vertical, but as I was explaining before, remember that has completely different risk parameters and it's a whole different emotional situation when that short is up there and you're barreling towards your short, not to mention that the maximum money that can be made from the short vertical is what? Is the credit received. But if the BWB is long at the 485 here, this could actually make $5. So you could theoretically, right, put it on for a credit of the 60 cents and make $5 more if we were to go up here and come up against the channel. Now that doesn't seem like it's happening, which is fine, but I'm just saying that this is the perfect example of how this type of spread can win two ways, so to speak, right? That it can actually win, you know, in two ways, basically get another credit going. All right, so that's NFLX. All right, let's move on to the next type of trade. This one is called ratio spread. This has historically been my favorite spread to employ. over time, it has really become my favorite. And it's not an easy spread to put on. It takes a while to learn it and get it right and know when to employ it and how to employ it. But if you know the tricks to it, it can really be one of the most lucrative spreads there are. So what is a ratio spread? A ratio spread is very simply where you are essentially doing a butterfly without the top or bottom strike, right? As you can see here in the picture, right? What does this look like here? It's a +1 on the call side and a -2, but there is no extra strike up here covering it. So it's essentially open-ended. It's like a long vertical and a naked call. And if it's on the put side, it's the same thing. It's just a long put and 2 short puts. And thus it's 1 long put vertical and 1 extra -1 down here, okay? Now, you can structure this in a couple different ways. Could be a 1-2 structure, as you can see in the picture, or it could be a 1-3 structure. I don't ever advise going higher than 1-3. That's a little crazy. If you're going to buy one option and sell 4, you're really putting on a lot of naked risk. But I do 1-3 very, very often, okay? It is the most powerful and versatile of spreads. And as I said, it is my favorite spread to employ in almost all situations, with a caveat that it can't be done in all stocks. You know, it's not possible everywhere, but potentially. This spread can eat up a lot of margin. This is true, right? Because naked options eat up a lot of margin, but can be adjusted to a broken wing butterfly, right? What does that mean? Well, if this is your spread, what's a broken wing butterfly? As I explained in the prior slides, just add this, right? Just add one. And what does that do? Bingo. Caps off your margin. All of a sudden, it's not unlimited risk, and your broker is happy again, right? And you're not getting a margin call, all right? This is an excellent trade for credit collection or sideways trade. Very important. If the market's not going anywhere, but you have a stock that has relatively high implied volatility, if you're in this structure, you are going to make money no matter what, because the simple passage of time is going to knock the stuffing out of these 3 shorts far more than it's going to take the value out of your 1 long. And your profit will move up like that. All right? It is also extremely powerful for directional trades. And I'm going to get into that in the next example. You'll see how I employ it. Think of the shorts as financing for your long call instead of seeing them only as risk. I'm pausing purposely for dramatic effect. Seriously, I am pausing right now for dramatic effect because I really want that to sink in. Because I've been there, I've been a new trader, I've been an inexperienced trader, I have traded options for 20 years now, but I know what it feels like to have extra shorts on, and I know how scary it can be for newer traders. So I say to you again, the purpose of the shorts is to finance your long. Do not look at them only as risk. They are risk, but they are risk that is serving a very specific function. You're selling those in order to buy this and not pay anything. And that is very, very powerful. Okay, so just keep that in mind. All right? Okay, let's get into another example. So again, live trading example from a recent trade. This one was closed relatively recently. Very, very powerful with a 1-3. So what did we do here? First of all, you'll notice that it says sold here where it started. Okay, this is important. I don't know why this thing is kind of acting funny, but ratio spreads are always sold to open. This is the terminology that sometimes screws people up with ratios. They're always sold to open, and this is important. And the reason for that is because in the terminology of floor traders, I guess back in the day, if you're doing a calendar or a diagonal or a ratio, when you say sold, you are always referencing that which you are selling that's in the back, meaning it's either further out in time or it's further out in price. So because the ratio spread is always entered by buying strike that's closer to you and selling the strike that is further away, we call it sell to open. Okay, so you can see here that it says clearly sold. You know, that we basically sold it to open right here. Okay, so we sold 4 units on ULTA, and what did we do? We bought 455 calls and we sold 470 calls 3 times. So we sold those 3 times. And because of the structure of how it was, where we bought 1 and sold 3, our cost was 5 cents. Our total cost was 5 cents, and we call that a directional ratio. And look at the exits right here. $1.25, that's 25 times our cost, and $2, that's 40 times our cost. So what was put on for a nickel was taken off for these prices right here, which is pretty amazing, right? I mean, huge in terms of percentage of gain off of what your cost is. And remember what I was saying earlier about being directional with this type of spread. This stock moved in the direction that we wanted, but what if it hadn't? What if it hadn't? What would have happened? How much would I have lost? Well, if I did nothing, 20 bucks, a nickel per contract. But you know what? I probably wouldn't have lost a nickel per contract. I would have still made money. Why is that? Because the 3 that I'm short would have kept losing value faster than the 1 that I was long. And within a week of putting on this spread, regardless of where the stock was, you couldn't put it on for a nickel. It would cost you 40 or 50 cents to put on, because by then the value of premium in the 470s would have eked out to like almost nothing. And you'd be paying a pretty penny to get those 455s. You see? So this is why these spreads are so exciting. What I was saying is that you can make money up, down, or sideways if you understand the structure properly. All right, let's take a look at the chart so we understand why this was done and where. All right, so here's ULTA. And look at the entry here. So again, everything I do is very, very technical. 100% technical. I don't guess. I don't use probabilities. I don't say, yeah, let's sell this option because it's got a 30 delta. Hell to the no. I never do that. It's all technical. Everything is driven by the chart. And if we are selling calls, we are selling calls at resistance. If we are selling puts, we are selling puts below resistance. And the impetus for every directional trade is that some event is happening on the chart. So if you look at this chart, obviously an event is happening right on the day we entered, because what's happening? It's breaking into this gap. We know that the stock gapped down on earnings here, and then it did what it did, and it started strengthening up and went where? To the bottom of the gap. So obviously we want to be long. So why did I structure this way? Well, it made sense to me, because a lot of times when stocks move into gaps, they don't necessarily always rocket higher. They do what you see here. They just sort of dribble higher. And lo and behold, what happened? Look at this. Look at the high price of the stock here. It never even made it to 460. Barely. We barely got in the money here. But do you see how, because we're leveraging time properly with the 1-3 structure, right? Because we are leveraging time this way, as price was going up slowly and really doing not much of anything, the spread was expanding, as I showed you before, to $1.25 and as much as $2, right? Which is massive. And again, as I was saying, like think of different structures that could have been effectuated on the breakout, and how would they have acted? My long call didn't start until 455. Do you think that if you had bought the 455, 470 straight vertical, which would have cost you like almost $3 or something, do you think you would have made money on this trade? I don't think so. I don't think you would have made money. Every day that went by would have been another day where the stock was moving up, but not really high enough for you to make money. And I'm saying if you had bought the call that's like 1 week out in the same time frame that we did, I don't think it would have made money. And you certainly wouldn't have had this dramatic expansion of, you know, paying a nickel and then closing it for $2. It just wouldn't happen, right? So this is where these structures, I think, can be really, really exciting if you know when to apply them, which stocks to apply them, and how, and et cetera. You know, there's obviously a little bit more to it, you know, behind the scenes, you know, that I don't have time to show you everything, but, you know, this is it. In a nutshell, you're seeing real life examples of how, you know, how these strategies work. All right, let's move on. Okay, this is the last one I want to share with you. This one is called risk reversal. And I specifically wrote on this slide, the big secret to my success. And obviously I put it in quotes because how much of a secret can it be if I'm giving it out, right? Here I am giving it away for free, right? This is really important. And I purposely wanted to use this as my third and final example of different types of spreads or trades that I do. What is a risk reversal? And why is it the big secret, okay? A risk reversal, simply put, is just a trade where one side pays for the other side. So that means that it's a trade, generally a directional trade, meaning we think the stock is going up, let's say, and it's a trade that has both calls and puts in its structure, okay? So it means that you're doing something on the call side that's actually going to make money because the stock is going up, but you're also doing something on the put side that's paying for that call structure. So as you can see in the second bullet point there, a short put structure finances call debits and a short call structure finances put debits. And that would be obviously if you thought the stock was going down, okay? This is important and to note because as I said here in the next point, most traders, when they look at what they're going to trade, they never consider door number 3. Door number 3 is if your stock goes sideways. People have a plan for what they're going to do if the stock goes up, and maybe they have a plan for what they're going to do if the stock goes down. And that's okay if you're just trading equity because all you need is a stop loss, right? If I have 500 shares of Tesla, I bought it here. I think it's going 15 points higher. My plan is to sell it here. If it goes $5 lower, I have a trailing stop in. Great. I know what's going to happen. There's only 2 outcomes. But when you speculate on direction using options, it's a little more complicated because time is working against you. As you know, you have the luxury of paying less for a call vertical, for instance, than buying shares of Tesla, but you also have the double-edged sword of time working against you. And so you need to understand that as you know, I'm sure many of you know, you have a basic, rudimentary understanding of options. If the stock doesn't move and if the stock doesn't move fast enough, you will lose money. Your call vertical goes to 0. And that's a problem. And most traders don't really plan for this. I like to do things a little bit differently. I always assume that door number 3 is a potential outcome. And that's why I like to structure as a risk reversal, meaning that if I'm going to lay out debit to be long on one side, I want to have short put credit on the other side. If I think the stock is going down, I want to have short call credit on one side that's going to pay for the put side. All right? Most importantly, it must be technically based, must be technical analysis based, and this is important. Do not, under any circumstances, sell anything just because it has a certain price tag attached to it. Right? Have any of you ever sold a call just because it was the call that was worth $1? Have any of you ever sold a put because it was the one that was worth whatever, X? Do you see my point? Many newer options traders make this mistake. They sell credit by looking at the options chain. The options chain is the last place you should be looking before you sell credit. You should check the chain to see if there's decent open interest and volume and what the spread is. That's about it. But you should not be concerned with what the prices are per, for each strike, or more accurately, that should not drive your decision as to which strike you're going to sell. The strikes that are to be sold must always be driven by technical analysis. You will always sell credit below support. You will always sell credit above resistance. Always, no matter what. Just like I showed you in the first example of Netflix. We could have gotten way more credit if we were selling 470 calls or 460 calls. But I sold 490 calls inside of that structure for a reason. Because I thought, okay, if this stock goes parabolic, where's it going to go? It's going to go up to the top of the channel and it's going to die right there. And if I have a broken wing on, I might actually make more money if I can stop it right up against that 490. There's specific reasons for it, okay? Last but not least, be creative. This is important. I hope you're kind of getting that from this presentation, that this stuff is creative. Think outside the box. The best trades usually have different structures on either side. That means that you don't have to buy a call vertical on one side and sell a put vertical on the other. You can have it different structures. You can have a long vertical on the call side and have a long broken wing butterfly on the put side for a credit. You can also ratio them, meaning like something that happens very often, and you'll see in the next slide. What happens in the weekly options advisory is if we want to get into a risk reversal, we may buy 8 broken wing butterflies on the put side, and maybe they have a credit of 50 cents. So we bring in $400. Well, now we have $400 to spend on the call side, but the call vertical that we want costs $2. Well, we can only buy 2. That's fine, right? So we've got 2 call verticals and 8 broken wings on the put side, and our net cost is 0. But remember, we don't have to match up 1-to-1 in numbers of contracts, and we don't have to match up in terms of structures. So be creative. You can have different structures on different sides and different sizing as well, okay? Let's move on. Okay, so let's go to our last example here. This one is called a risk reversal in QQQ. And I purposely chose this trade specifically because it's a losing trade and not a winning trade. And you'll see why, as I go through why I specifically chose it, because what I wanted to point out to you all in the trade is that this trade was dead wrong on direction. It was, the charts basically gave me a signal. I thought it was going to be long. I'll show you in a second on the chart where the day that it was entered. To me, it looked like a straight up long, made perfect sense to me, but it didn't go. But because of the structure, the way it was set up, notice that the loss was very, very small, that it turned out to be 43 bucks. It was a very, very small loss. So what exactly happened in this trade? Basically got long. I'll show you here. Here it is right here. When I saw the pullback here in QQQ, this was on June 20th. So you can see this was literally just this week. I thought that the next move would be up. Made perfect sense, right? We had a pullback to the 8 EMA, right? I would probably do this again 1,000 times over if I was presented with the same thing. I thought the next day would be higher. Guess what? I was wrong. So what did I do? Look at our structure over here. Sold 8 puts at 357. Why 357? Because 357 is this breakout point right here, right? So I figure, okay, stock is probably not going below that level. And then I spent the money, and notice that there's a difference in size here. I had to sell 8 of these and buy only 4 units of this structure. And this is an interesting structure because you can see that it's a broken wing, but it's a broken wing in the other direction where the long vertical is actually longer than a short vertical. And interesting enough, in Shadow Trader and Weekly Options Advisory, we came up with a funny name for this. We call it the reverse mullet. So I'll call it the RM. It's a reverse mullet because, as you know, a mullet haircut is business in the front, party in the back. This is a reverse mullet because it's party in the front, business in the back, right? The party is in the front right here with a $2 wide call vertical. This is where you're going to make money. Woo! This is the party right here. The business is the risk control, right? Nobody wants to talk about, risk control. That's boring, right? So the business is in the back where buying the 369 here caps off the risk if the QQQ was to shoot all the way through, right? If this was a regular butterfly and you shot all the way through it, it would be worth 0. But in this case, because of this structure, it would be worth $1. right? Because this is 2 long vertical and this is -1. So it would still be worth $1 and it still could have a max value of 2 in the middle. And so the way I structured my net cost was only 18 cents a contract as opposed to what it would have been if I had bought this outright and I didn't sell any puts at all. Okay? Let's just go back to the prior slide for a second so you can see how this worked out. So again, we sold the 357 puts 8 times, and then we used that to buy these 4 here. And then here's what happened was the way the trade lost very little money is that even though we went down quite a bit, because this was set up as a DTE1, notice that this was put on June 20th and we were getting out the next day, they were expiring. The puts that we sold for 15 cents, we were still able to close them for 3 cents. So even though we paid 48 cents for the call structure, as you can see here, we paid 48 cents for the call structure, the net cost was 18 cents instead of 48 cents. And then we did get out of some of the call structure here, 19 cents and 15 cents. We left the last one on, which just went to 0. I mean, we could have sold the other one for 15 cents and maybe, you know, we would have taken this loss down a tiny bit, but because the loss was tiny, we just let the other one ride. And the market at that point had just kind of fallen apart so badly that it wasn't possible. But it's interesting that even on the gap down, it was just a slight gap down and the market started moving down kind of a little bit after. We were still able to close the short puts for 3 cents because they were probably because they were in the right spot, basically. You know, the puts were in the exact perfect spot where they needed to be. So I just deemed them to be safe regardless. But this is a great example I just wanted to show you on the risk reversal of how, because of the structure, because of having that short put structure financing that, here we were dead wrong on direction. The stock, you know, the Qs didn't go up the next day. They actually ended up going down, but the loss was very controlled. And again, had you speculated differently with a long vertical or a long butterfly without a risk reversal or reverse mullet that you paid for without selling the puts or whatever it is you're doing, the outcome would have been very, very different. All right, so does this stuff work over time? Well, here it is. As I said, I've been doing this for over 6 years, this advisory, and this is the equity curve. This is a plot of every single trade that has been done since inception. We are currently up to trade number 1,240. Every single trade has been documented. And again, as I was saying, it's in a PDF of an Excel that every subscriber gets every day. And this has been the equity curve from start to finish. And you can see that the equity curve is pretty solidly just going in one direction. And we are usually at our high water mark, you know, all the time. You can see we're just kind of climbing steadily in one direction. So over time, these strategies definitely do work. And I'm excited to be, you know, sharing them with people. So this is essentially what I have on offer. This is the advisory that I was just showing you the live trades from. It's called Weekly Options Advisory. It is $95 a month, which is really quite a value for the amount of things that you're getting, which is all of my live trades in real time, plus all of the management and hand-holding and everything that comes with the trades. Those come to your desktop through the pro trading room that you're in right now. It's exactly like the one you're seeing now, or to the mobile app, as I was telling you. I do go live in the room every day. I'm usually live from anywhere between 2 and 3 hours every session, usually in the morning session when things are a little bit more hot and heavy. So you'll see me at the open for the first few hours during that time, or even all day long, really, because I'm actually in the room all day long. Even if I'm not broadcasting, you can always private message me. You can ask a question. Anything like that, everything goes there. We do send a daily recap email every day at the end of the day, which is really a nice thing to have because if you miss an alert or you weren't sure of everything that happened, you can check it in the email. So that comes to subscribers every day, and that email also has the link to the most current performance sheet as well. So all the trades are updated in real time on the day they're done, and then when you get your recap email, you'll be able to click to see the current day's performance. If we close the trade that day, it's right there, win or lose. Everything's very transparent. Everything is updated there immediately. And subscribers to Weekly Options Advisory, and this is exclusive to Weekly Options Advisory because Squawk Box doesn't get this or anything else that we do on Shadow Trader, you get a free subscription to Peter's Pre-Market Perspective. So this has a lot of value in and of itself. This is the market profile newsletter that I write every morning, comes out at 9 a.m. Eastern before the market opens. And it's essentially my analysis of the overnight trade, what the futures are doing coming into the open, key levels, scenarios, value areas, pivots, all that stuff. It's all in one report for you. And again, that comes out pre-market. And if you're part of my weekly group here, you do get a free subscription to that. It is included, all right? We never do a contract here at shadowtrader.net. It's always just very, loose, cancel anytime. Stay as long as you like. If it's not for you, that's fine. And like I said, it's $95 a month, and this is all available right here at our site at shadowtrader.net/options. All right. If you guys have any questions whatsoever after viewing this webinar, and again, it has been recorded, so it will be sent to you. Shoot me an email personally. I'm at asktheshadow@shadowtrader.net. I would love to answer any questions you have. I'm totally, anytime. Always available there. So again, just send me an email at asktheshadow@shadowtrader.net, and I'd be glad to help you. All right. That's all. Thank you guys so much for attending the webinar, and I hope to see you soon in the Weekly Options Advisory, and I wish you good trading and good night.